Here is something that should stop you cold. McDonald's just announced a $3 value deal, the cheapest offer the chain has put on the menu in years. And before you file that away as just a fast food story, consider what it actually means when the largest restaurant chain in the world keeps having to cut its prices. Not once, twice now, in under 2 years. This is not a promotion. This is not a seasonal gimmick. When McDonald's does this, it means their customers cannot afford to come back at the old price. And when I say customers, I mean tens of millions of Americans who built that company into what it is. Those people are tapped out. McDonald's just told you that with a $3 meal. And McDonald's is not the only one sending that signal right now. Pepsi is cutting prices on core brands like Lays and Doritos by up to 15%. Dollar Tree is watching higher-income shoppers flood its aisles in numbers the company has never seen before. 3 completely different companies across 3 completely different product categories, all of them saying the exact same thing about where the American consumer actually stands in 2026. That is what this video is about. Not just the individual moves, the pattern. Because when you see McDonald's and Pepsi cutting prices at the same time that wealthier households are being driven into Dollar Tree, you are not looking at isolated corporate decisions. You are looking at a consumer economy that is fracturing from every direction at once. Top, bottom, and middle. And that was the situation before the energy shock. Before wholesale gasoline jumped 60% in a matter of weeks. Before diesel crossed $5 a gallon. The match was already lit. The energy shock is the accelerant. We are looking at this from 2 distinct angles today. On one side, you have McDonald's and Pepsi, 2 massive consumer brands cutting prices because the customers they were counting on simply do not have the income to keep spending. On the other side, you have Dollar Tree, watching people who earn $100,000 a year show up in its aisles for the first time ever because even those households are now hunting for a deal. Both of those things happening at the same time, and both of them pointing to the exact same conclusion about this economy. We have got a race against time. Let's get into it. Let's start with McDonald's. And let's go back to how we got here. Because the current situation did not happen overnight. After 2020, McDonald's raised its prices substantially. The logic was simple. The Fed was calling the labor market strong. The recovery was supposed to be real. If consumers were coming back, if incomes were rising the way the government kept insisting they were, then McDonald's at higher price points was a perfectly sensible bet. So they made it. And for a while the numbers held up, but the customers started disappearing. Not dramatically at first. Slowly, traffic softened. Same-store sales started going the wrong direction. Core customers, the lower and middle-income households who kept McDonald's running for decades, were cutting visits. Not because they found somewhere better, because they could not afford it anymore. By mid-2024, McDonald's had posted its first negative same-store sales comparison since 2020. That is a significant milestone. And what did the company do? They rolled out a $5 value menu. Not because they wanted to, because they had to. Because their own sales data was telling them the customer they had been banking on was gone. And here is what was interesting about that moment. The Fed was still calling things resilient. Payroll reports were still being described as solid. And McDonald's was handing out discount meals to get people back through the door. One of those things was honest about what was actually happening in the economy. It was not the Fed. Now it is March 2026. McDonald's is launching a $3 deal. Even cheaper than the $5 menu from 2 years ago. And the reason is the same reason they did it the first time. The customer has not come back. Things have gotten worse, not better. The labor market has continued to deteriorate. Job losses that were just beginning to show up in 2024 are a real problem in 2026. Fewer paychecks, less income, less money walking through the golden arches regardless of what number is on the sign out front. CEO Chris Kempshank said it plainly in the February earnings call. McDonald's is not going to get beaten on value and affordability. The company is doubling down on being the cheapest option for its core customers. That sounds confident. But what it actually means is that McDonald's customers have so little money left that the company has to keep cutting prices just to compete for what little spending they still have available. Even as quarterly sales showed a modest uptick, executives on that same earnings call acknowledged the fast food environment would remain challenging throughout 2026. The company specifically called out lower-income consumers. This tier of customer, they said, has been dealing with persistent income pressure for years and is broadly pulling back on spending. Broadly pulling back. That is not a niche observation. That is a structural collapse in purchasing power among the largest segment of McDonald's customer base. And it is not just McDonald's saying it. Wendy's is saying it. Taco Bell is saying it. The entire quick-service restaurant sector is now competing for a shrinking pool of customers who have less to work with every single month. This is an industry-wide distress signal. Now let's go to Pepsi. Same story, different aisle. Like McDonald's, Pepsi spent the post-2020 period raising prices on its core products. The calculus was identical. If the recovery was real, consumers would absorb higher prices short-term and volumes would bounce back once things normalized. Pepsi raised prices on Lays, on Doritos, across the portfolio. Volume dropped. They accepted that trade-off. They were betting the Fed was right. The Fed was not right, because the customers Pepsi lost when prices went up are not coming back. Nothing changed for them. Incomes did not recover. Jobs did not improve. They still cannot pay $6 for a bag of chips any more today than they could 18 months ago. So earlier this year, Pepsi admitted the strategy had failed. The company announced price cuts of up to 15% on core brands, including Lays and Doritos. This came out with their fourth quarter results. Rachel Fernandino, CEO of PepsiCo Foods US, said on the earnings call that customers had told the company they were feeling the strain, that new pricing would be on shelves immediately, and that this decision came after a year of listening closely to what consumers were telling them. Let's be honest about what that statement really means. Pepsi did not need a listening campaign to understand the problem. They had quarterly volume data for that. The framing is just corporate language to soften the announcement that a multi-year pricing strategy has completely failed. They followed the Fed's recovery narrative. The recovery did not materialize the way the Fed promised, and now Pepsi is paying for it. Procter & Gamble, Coca-Cola, now PepsiCo, all of them cutting entry price points. All of them trying to win back customers they drove away. The price hiking era of the early 2020s is finished. What ended it was an economy that forgot how to grow and then started remembering how to cut workers. Now let's flip to the other side of this equation, because Dollar Tree is telling the same story from a very different angle. Dollar Tree just reported decent quarterly results. Sales up, traffic up. The company is expanding into the $3 to $5 price tier with toys, seasonal goods, party supplies. On paper, that sounds like a business that is doing fine. But look at where that growth is actually coming from. Dollar Tree's numbers are being driven by households earning $100,000 or more per year. Wealthier shoppers who, in any genuinely healthy economy, would never step foot in a Dollar Tree. They are now showing up in numbers the company has not seen before. They are the growth engine right now. That is the same dynamic Walmart has been describing for 2 years. Higher income consumers migrating into discount retail because they are feeling the squeeze too, searching for value in places they would have considered beneath them 3 years ago. And for Dollar Tree, those shoppers are currently carrying the results. Meanwhile, Dollar Tree's core customers, the lower-income households the business was built on, are pulling back. They are leaning on larger pack sizes to stretch their money further, making trade-offs just to get through the month. CEO Michael Creedon confirmed on the earnings call that rising gasoline prices are already affecting lower-income shoppers. And those prices have only moved higher since that call happened. So here's the full picture right now. Wealthier consumers pushed down the retail ladder into discount stores. Core discount shoppers pushed further into financial stress. Both things happening at the same time, from the top down and the bottom up. And none of this is pandemic aftermath anymore. This is the steady state of the consumer economy in 2026. Before any energy shock, before the gasoline surge, before diesel crossed $5. That last point matters, because everything we just covered, McDonald's price cuts, Pepsi price cuts, Dollar Tree being flooded with $100,000 income households, all of that was already in motion. The energy shock did not create this situation. It arrived on top of it. And that changes everything about how dangerous this moment actually is. Wholesale gasoline prices have risen roughly 60% in a matter of weeks. At the CME, wholesale was trading between $3.10 and $3.20 per gallon at the time of this video. That is up from around $2 per gallon not long ago. And critically, those prices have not fully passed through to the retail level yet. What consumers are feeling at the pump right now is just the beginning of the transmission. The full force has not arrived. Diesel has already crossed the $5 per gallon threshold at retail. According to AAA data, diesel reached $5.04 per gallon, up from $4.78 the week before, up from $3.65 just 1 month earlier. The last time diesel was this expensive was December 2022, and even then prices were declining from a record peak of $5.81 per gallon reached in June 2022. We have returned to near-record levels in a fraction of the time, and petroleum analysts say upward pressure will likely persist until oil flows through the Strait of Hormuz normalize. That word, persist, that is the key word in this entire conversation. Because energy shocks are not inflationary in the traditional sense. They do not generate wage growth that circulates back into consumer spending. They work exactly like a tax. A sudden, inescapable tax hitting consumers and businesses simultaneously. And unlike most costs, energy is inelastic. You drive the miles you drive because you have to drive them. You go to work. You get your kids. You make the delivery. You cannot cut your fuel consumption to zero because the price went up. So you pay it. And you cut something else. Consumers cut restaurant visits. They skip discretionary shopping. They delay purchases. They pull back exactly at the places McDonald's and Pepsi and Dollar Tree are already trying desperately to hold their footing. Small businesses do the same in their cost structure. Pull back on raises. Cut hours. Delay hiring. And if the shock runs long enough and deep enough, they start letting workers go. And when more workers are let go, fewer people spending. Fewer customers walking through any door. Less revenue for every company we talked about today. Less revenue means more cost cuts. More cost cuts means more layoffs. The loop tightens, and it was already tight before the shock showed up. Now let's put this in historical context. Because this has happened before. The details are different, but the structure is the same. In 1990, the US economy was already fragile. The savings and loan crisis had created a real credit contraction. Business conditions were soft. The labor market had stopped growing meaningfully. Then Saddam Hussein invaded Kuwait. Oil went from roughly $15 a barrel to roughly $40 a barrel in about 3 months. Job losses were not yet widespread when the shock began. By the time prices peaked, they absolutely were. A weak economy absorbed a sudden energy shock and broke. The United States and most of the developed world went into recession. And it did not take years. It took months. Same pattern in 1973. Same pattern in 1979. In every case, the energy shock was not the origin of the weakness. It landed on top of a system that was already stressed. It was the weight the structure could not carry. Now consider the contrast between 2022 and 2026. When the last major energy shock hit in 2022, there was genuine forward momentum in the economy. Not a full recovery. But things were moving upward in enough sectors that there was cushion. Even with that cushion, the 2022 shock contributed to recessions across multiple economies through 2022 and 2023. And that recovery never fully came. Almost 4 years now of the economy stuck and stagnating. For years of forgetting how to grow. And now the energy shock is landing on top of that. Job losses are already happening before the shock has fully passed through. Consumer sentiment is deeply negative. Corporate America is revising its strategies in real time. McDonald's is cutting prices. Pepsi is cutting prices. Dollar Tree's core shoppers are getting squeezed out. The shock is not arriving on an economy with cushion. It is arriving on an economy that was already leaning against the wall. The Federal Reserve announced this afternoon they are holding rates steady. Their dot plot showed continued movement toward cuts, not hikes. Which means the FOMC is finally looking at the same labor market that McDonald's has been reacting to for 2 years. Maybe they stopped at a drive-thru before the meeting. Either way, rate cuts are not going to solve what McDonald's is describing. They are not going to put income back in the pockets of people who already stopped coming in. So let's be specific about the actual downside scenario, because this is what matters most right now. If wholesale gasoline prices pull back in the next few weeks, the damage is real but manageable. The system takes a hit and absorbs it. Consumer spending contracts further. But there is no clean break. If those prices stay elevated for 2 months, 3 months, 4 months, that is the 1990 template running in 2026. That is enough duration and enough magnitude to take the job losses that are already happening and push them into genuine acceleration. And once that acceleration starts, it feeds itself. Fewer jobs means less spending. Less spending means lower revenue at every company we covered today. Lower revenue means further cost cuts. Further cost cuts means further layoffs. Round and round. This is why calling it a race against time is exactly right. Every week energy prices stay elevated is another week of damage being absorbed by a consumer and business base that has zero margin left. Every week narrows the window for things to stabilize before something more significant breaks. And this is before considering the other pressure mines in the water right now. Stock market stability is not guaranteed. Private credit markets are under real stress. The dollar is under pressure in ways that carry their own implications for what comes next. Any one of those things developing further adds weight to a structure that is already overloaded. We are not in a gentle slowdown. We are not threading a soft landing. We are navigating a very narrow channel with pressure mines on every side. The consumer is the channel, worn thin before the mines ever showed up. And every day we stay in that channel without getting through it, the odds of hitting one go up. McDonald's already told you where the consumer is. A $3 meal told you that. Pepsi's 15% price cuts told you that. Dollar Tree's $100,000 a year shoppers hunting for a bargain told you that. The question now is how long the energy shock runs. That question does not have a comfortable answer yet. Thanks for watching.